is that the Fed fund futures were being priced into June of 2027, and they were pushed all the way back out into September. Now it's going to be interesting to see where we reopen because there's a perception that the ceasefire is going to be extended. The reality is, though, is that nothing has really changed, and some of the really important things that we should be watching out for here as we go into the rest of this week is the first thing is that the dollar and crude oil are ripping. The dollar and crude oil are ripping, and that is kind of contradictory to what you would perceive in this situation. And it just goes to show you, how important it is to have a process, to not get pulled in one direction or another by news events or the perception of news events. If the dollar is rallying individually because of the negative correlations that we have, it will drag the indices down. And the big question that I think is important this week is how long does it take for the dollar to drag the indices down? And it is only a matter of time in our current correlations. There's a negative 0.9, negative 0.8 correlation right now. So the dollar is ripping away from support levels. The euro is collapsing away from its resistance levels. As you can see here, almost a perfect traditional short coming out of Monday, and then almost a perfect halfway back as we were coming out of our overnight and then into this morning time frame. The dollar is ripping, and then there is the separate force inside of our markets, which is crude oil, and crude oil rallying. Why is that a separate influence? Well, when crude oil is rallying, the Fed fund futures are being pulled, pushed back out into the future. And when you're thinking about that force inside of our markets, crude oil is pricing in that this crisis or this conflict is going to just be extended the way that it is. And if that choke point remains, the dollar strengthening and crude oil strengthening are going to be incredible headwinds against the broad markets. And that's going on right now. Now, this is what's important about the actual leading indicators of the broad markets, though, is that the VIX is falling back down into a support level. Now, you can see here yesterday that we ran right into these big daily short setups, and then we broke longs from Monday's lows to highs. And that's what gives us this 50% short above us here on the VIX. But you'll notice that it leads us back down into the lows of the week. And then it leads us back down into the long from our old contract lows to highs. That's what we bounced off of on Friday and then completed profit targets by Sunday night, Monday last week. And I think the case that could easily be made here is that the VIX is trying to get its fill. Wall Street is trying to get its fill here inside of that volatility long setup. And that if we're very diligent about trading the indices and trailing them back up into our previous highs and the VIX back down into these previous lows, that if we were to break through these VIX short setups from these... This stream continues at emoneyaddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.